Are you feeling the pinch of higher mortgage interest rates? Refinancing could be the answer. Now, what is a refinance? Refinancing, in simple terms, is replacing your current mortgage with a different mortgage, a better mortgage. It could be a number of reasons. It could be for a lower payment. It could be for a shorter term. It could be for bringing cash out of your property and putting it into your pocket. So we need to look at when refinancing makes sense. And the most common reason is your interest rate, when you're trying to take your current interest rate and lower it to a different interest rate. So look at this example. So if you have a $400,000 mortgage at a 30-year fixed 6.75 interest rate, and you refinance into a 30-year 5.25 interest rate, that is $386 a month cheaper. That's a big win, but you need to do the recoupment calculation. Everyone focuses on interest rate. You know, I have people all the time say,
"Hey Jay, I got 5.25% interest rate."
But that's half the equation. They're not telling you what are the costs associated with that. What are the discount points associated with that? So that's like me saying,
"Hey man, I did 500 push-ups."
And if I just tell you that, you might be like,
"Oh, that's pretty good."
But if I say,
"Well, over the course of a month, I did it over the course of a month,"
they're like, "Oh, it's really not that as impressive anymore." So you have to tell the whole equation when looking at interest rates. You could also be refinancing for different financial goals. So we have to look at, what is your goal? Is your goal purely to lower your monthly payment? Okay, we can set it up that way. Is your goal to shorten your mortgage, going from a 30-year term to maybe a 20-year term, or maybe a 15-year term? Or maybe you purely want to access your home equity and tap into that and take some of it and either pay off other higher interest debt, right, with a debt consolidation. Or maybe you're wanting to do home improvements, put it in a swimming pool, son or daughter is going to college, any number of reasons why you're trying to tap into your equity.
Money.
For those who don't know, home equity is the difference in your home value versus your mortgage balance. So if your home is worth $700,000 and you have a $400,000 mortgage, well, then you have $300,000 in equity. Now that doesn't mean you can just take all that $300,000 out. It depends on the mortgage type, but you're not gonna be able to tap into all of your equity. So on a cash out refinance, let's take that $300,000 example. Let's say you want to tap into 50% of it. Well, then that's $150,000, half of 300. And so your mortgage balance is going to go from $400,000 to $550. So that is a very simple way of how a cash out refinance works. A very common, easy, streamlined refinance is a streamlined refinance, right? These are for VA, FHA, USDA loans. All right, the most common is the VA IRRRL, which is the interest rate refinance reduction loan. That is when you're simply changing your interest rate, it's lowering, and the beauty of it is you don't have to verify your income, you don't have to verify your employment, you don't have to verify your assets, we don't have to order an appraisal, all these things that you did during the purchase process, you don't do. It's extremely streamlined. Okay, great. So you want to move forward with a refinance. Here is a quick overview of what happens. It starts with the mortgage application. Just like you did when you bought the home, assuming that you bought it with a mortgage and didn't pay cash. But if you bought it with a mortgage, you applied, you filled out a mortgage application, your job history, your address history, your finances, all that, you have to fill one of those out again. And then we're going to be doing an underwriting process. If this is a conventional refinance, if this is a rate and term refinance, meaning we're just changing your rate and changing your term, we have to verify your income, we have to verify your employment, we have to verify everything, pull your credit, all that stuff to make sure you can afford it. Now, the good thing is, you may or may not need an appraisal. It depends on loan to value, it depends on credit score, depends on a variety of different things, assets, reserves, but you may not need an appraisal. Like, for example, if you have a 50% loan to value, meaning your loan balance is $250,000 and your home is worth $500,000, and you have a great credit score and all that, like, you probably have a pretty good chance of not needing an appraisal. So that's nice. But on a rate and term refinance, it is a full underwrite. Same as when you purchased. Same on a cash out refinance. The only time you do not do that is on a streamlined refinance. One of the biggest parts of a refinance are your closing costs. So remember that example earlier when I said, hey, going from a 6.75 to 5.25 interest rate, you're saving $386 a month. That is great. If the mortgage refinance is costing $5,000, $6,000, $7,000, that probably makes sense. Okay, so when I talk closing costs, the main driver is usually title insurance. Title insurance follows the lien. So if you are paying off one lien and starting a new loan, then you need title insurance again. There might be origination fees, but they're usually cheaper than like a purchase. Depending on your state, there might be recording fees, county fees, stamps, all this stuff. Like Maryland, Texas, where I live, does not have any recording fees. But you need to look at the total fees and then calculate the recoupment. If you're saving $386 a month and it's costing you $6,000, well then break out your calculator, right? Let's do 6,000 divided by 386. That is 15 and a half months. So round it up to 16 months. So about a year and a half to recoup your closing costs, but it probably makes sense. Somewhere right around there, I feel good about that, okay? If the lender that you're working with is charging you a bunch of discount points, a bunch of fees just to get that rate, so let's look at that. If it's costing you $14,000 just to refinance and you're saving $386 a month, that's 36 months, 3 years. I don't know if it makes sense at that point. You know, there might be better options. There might be something, maybe the rate's not, you know, the most ideal rate. So you need to look at recoupments. Don't focus on just the rate. Focus on the closing costs as well. That is equally as important. So that's a potential pitfall with refinancing. You see lenders sometimes advertise online or in mailers, or it's a no-cost refinance. It's a free refinance. Well, that's not necessarily true. There are costs associated with a refinance. Now, they might be giving you lender credit to offset it, but there's no such thing as a free refinance. So just be careful of that when you're looking at your options. And be careful about repeatedly refinancing. If you truly broke even, you know, after 12 months on a refinance, then you probably feel good about refinancing in the future. But if your break even was 3 years, 4 years, and you trying to refinance again, and you're only 2 years into that new refinance, well, then you haven't recouped that initial cost. And now you're going backwards again. You're losing part of your equity. You're starting your loan term over. Just be very cognizant about refinancing multiple times and not meeting the recoupment each time you refinance.
Got it.
So in the end, refinancing makes sense if you're lowering your cost and you're meeting your recoupment. If you're pulling equity out and you need it to go do things, you need it to pay off debt, you need it to make an investment, you're starting a business, whatever you're doing. If you're refinancing, make sure you're looking at the whole picture. People get wrapped up on how much money that they're obtaining on a cash out or what their monthly savings is on the rates. Make sure it makes sense though. You got to look at the full picture and look at the closing costs, look at the recoupment, look at the loan term. What is it doing? Is it extending your term? Look at everything and make sure it meets your financial goal. If you're a veteran, check out this video right here on VA IRRRLs. It's a streamlined refinance. It's the easiest refinance there is, and I lay out all the numbers on how to maximize the VA IRRRL.